growing web of regulations designed to constrain and redirect modern capitalism. Thus, we will explore the policies and entities involved in the subprime lending markets and how their actions brought about the 2008 financial collapse and the subsequent recession. Although a very complex issue, understanding the actors and financial structures involved in the crisis can shed light on the causal reality to allow the general public to draw their own conclusions. First, I'll explain the structures and players involved in creating the unstable situation, and then discuss the pressures placed upon the system that ultimately caused the system to collapse. Before delving into the nuts and bolts of the banking system, we need to address the overarching effects of the Federal Reserve's policies. The Federal Reserve was instrumental in making credit readily available. Kiplinger's Manias, Panics, and Crashes states the Federal Reserve as an independent regulatory body controls economic growth through setting of what's called the federal funds rate. Given the nature of the Fed's responsibility, its actions increase the accessibility of easy credit. Post-September 11th in the 2000 tech bubble, the Federal Reserve under Alan Greenspan cut the federal funds rate significantly to combat the recession and kept it low for several years. William Poole of the Harvard Journal of Law and Public Policy suggests that this protracted period of 1%, roughly 1% interest rates, caused the housing market to become too hot as millions of people sought to purchase loans because credit was so cheap and widely available. Investors also sought to purchase more risky investments that carried a higher return on investment because the federal funds rate kept savings account yields so low. Thus, the federal policies of low interest rates encouraged excessive lending and people to overextend themselves with debt, as household debt as a percentage of gross domestic product increased to over 140%, while savings reduced dramatically. However, while low rates increased demand for loans, politicians sought to expand home ownership and the American dream to poor minorities through legislation and government entities. The Community Reinvestment Act in the 1977 prohibited banks from redlining, which is denying minorities and poor mortgages. Banks were then mandated to make active efforts to lend to the underprivileged communities that lack the income criteria usually required in a lending situation, forcing banks to assume riskier loans that carried higher rates of foreclosure. Many had loans without understanding the terms, so they bought homes that they couldn't afford at interest rates that were too high for them to pay. Two government-sponsored entities, Fannie Mae and Freddie Mac, under the purview of the Department of Housing and Urban Development, were instrumental in expanding lending to these riskier persons. It's a common misconception that banks actually hold loans, when in reality they are purchased by Fannie Mae in a process called securitization. So these loans that are bought from banks are then sold to investors as what are called mortgage-backed securities. Thus, a homeowner who pays a mortgage payment actually is paying interest to investors on these mortgage-backed securities. The purpose of this scheme is so that banks can clear their balance sheets and continue to make more and more loans and expand the pool of home ownership. And banks continue to make these loans knowing that Fannie Mae and Freddie Mac would continue to purchase them. Thus, Friedman suggests that the Clinton administration's Community Reinvestment Act enforcement strengthened Fannie and directed them to buy and securitize more subprime loans. Subprime loans being loans that the borrower has typically a lower credit score and required little or no down payment, as the down payment was seen as the biggest obstacle to the poor. A New York Times article by Charles Duhigg suggests that although there were warnings that these subprime loans would never be repaid, Fannie's CEO, under direction of the Democrats in Congress, encouraged banks to continue to make more and more subprime loans, eventually amounting to $2 trillion worth. The U.S. subprime crisis article by BBC News, published in 2007, suggests that 1 out of 5 mortgages were subprime by 2005. Despite systemic problems in the Fannie and Freddie business model, curtailing their actions to remain politically unpopular, Stephen Lamberton's September article in the New York Times says that efforts by the Bush administration for regulatory overhaul in the housing finance industry failed along partisan lines, as Democrats in Congress felt that this would mean less and affordable housing. Community Reinvestment Act implementation through Fannie and Freddie encouraged banks thus to offer more subprime loans to riskier persons who couldn't afford them. However, the product of Fannie and Freddie's loan purchases caused other parties to be exposed to this risk. The underlying asset of Fannie and Freddie's mortgage-backed securities were highly demanded by investors for their return. The underlying asset, subprime mortgages of these mortgage-backed securities carried enormous risk for default and were rated high quality by credit rating agencies. Moody's, Standard & Poor's rate the quality of debt, typically bonds and mortgage-backed securities, on a scale to indicate their safety to investors. The AAA rating is typically the best, which is given to the government itself, and in this case, to these mortgage-backed securities. Friedman says that because subprime loans were guaranteed by a government-sponsored entity, that being Fannie and Freddie, it conferred an implicit AAA rating without examining the quality of the underlying asset. Because of these assurances of a high credit rating, individuals, banks, hedge funds, and pensions invested in these financial instruments and became exposed to this high risk. Americans and foreign investors poured trillions of dollars into these investments. Because of the huge injection of investment at all levels of the system, it caused an unsustainable demand for subprime loans and in turn caused housing prices to increase dramatically after the year 2000 up until the crash, causing an asset bubble that was bound to pop. The proliferation of subprime mortgages as a basis of investment posed a systemic risk to the economy as a whole, as everything became tied to them. Now we'll discuss how this complex scheme unraveled. The impetus of the recession was the simultaneous collapse of the housing and financial markets, which became increasingly intertwined by this point. Investment peaked in all financial instruments, and housing prices in specific markets became increasingly exposed, mainly California, Nevada, and Arizona. The housing bubble popped as prices collapsed, and holders of some subprime mortgages began defaulting. As defaults rose incredibly high, the value of the asset, the subprime mortgages, deteriorated, and holders of these investments sustained huge losses. The investment bank Lehman Brothers collapsed due to overexposure to mortgage-backed securities, along with AIG and some other financial institutions. Fannie and Freddie themselves required hundreds of billions of dollars in government bailouts to remain afloat. Commercial banks were also holders of these toxic assets and suffered huge losses, and they responded by reducing the number of loans that they made. This caused a credit squeeze as it became difficult for businesses and individuals to get loans because banks were unwilling to lend. As a result, the entire economy floundered without credit to purchase new equipment, payroll, and other activities, and mass layoffs ensued. In conclusion, we have discussed the origin of the current recession by examining the role of government and the subsequent actions of the various parties involved. The effects of subprime mortgages, in effect, derailed the premier economic power on earth. Though government played a major role in the collapse, it currently attempts to alleviate the credit crisis through TARP funds being given to banks in the hope that they will continue lending, and a myriad of new regulations and stimulus packages. However, Friedman reports that the effects of these policies have yet to be seen, and the recession